You don't know what you don't know. And this is why I believe we're seeing so many cult followings developing on these high yield ETF funds. And it rubs me the wrong way because as a day trader, I know what they're doing isn't special in any way. When I see investors putting this garbage into their account, I'm concerned for them in the sense that they're dipping their toes into the world of day and swing trading by accepting the risk. However, they're not gaining any experience from it. Before we begin, I want to make it clear that options are one of the hardest drugs you can take when it comes to the markets. So high level of caution, position size incorrectly, or enter an option position that's too illiquid and you'll get taken out by a rogue wave.
I am so sorry that I was unable to manage the rogue wave that hit us this week. You are my family, and I'm sorry that this rogue wave capsized our boat.
So let's get into this litter lesson. And I want to start off with the components of our covered call with a protective put. And we're going to keep it as simple as possible, so we're just looking at the base case. First, we need to have our 100 shares. Next, we'll sell an option, which is how we get our premium. It's not actually a dividend. And then we buy an option to protect ourselves. Now on the right side, I'm going to go over the components of this spread bet that I want to bring up later on. We'll sell an option, and then we'll use some of that premium to buy ourselves an option to protect ourselves. The two sets are almost isomorphic to one another, except for these 100 shares. I see a lot in the comments that people are saying, oh, I don't really care about growth. It's simply weekly income. Well, then these 100 shares are a liability that are exposing us to more risk for no real reason, and they're locking up a significant amount of capital. So let's just get them out of here. Once we remove these 100 shares, we see that the two sets are now identical. So really these covered call protective put things are just a spread bet with an extra step. On screen, we have one of the covered call bets that Ulti is playing this week. Because they own shares of this, they'll always be on the front lines of this never-ending price war, which is the most dangerous place to be, especially when you're forced to always be on Team Green. But at the same token, we don't want Team Green to actually win. Our only true win condition is if prices trade sideways. We lose if prices go up too much. We lose if prices drop down too much. So our one win condition is this tiny sliver of a green box. It's not ideal, but their bright idea is then to do this bet about 20 more times on extremely volatile stocks and betting that they all just flatline in unison. Now pulled up on the screen, I've got CRM, and it's one of my possible candidates this week for placing a spread bet. As you can see on the chart, it's been downtrending for some time now. If we're going to say that the front lines of this never-ending price war is wherever the price is at currently, then think of spread bets as a place where the battle shouldn't carry on. So you're going to deploy them somewhere where you're going to say, hey, this week price isn't going here. So as we look at this chart, do we see an area that we could possibly say, hey, if something happens this week, price isn't going there? So what I'm going to be looking for on Monday is that if price is selling off just a bit, I'll be looking to place a bet right around here. And I'll say, hey, this week price isn't going there, and I'm willing to bet $500 on it. And when we look to our option chain, if I take this bet, we'll make sure that it's 5 wide. There we go. They're willing to pay me $125 roughly to place that bet. That price doesn't end up in this box right here. And my win condition is that as the week plays out, the price can land anywhere in this green region box, and I win my bet. If it starts just landsliding, I can probably close my bet the very next day and call back those troops into the fold. Now for a little bit of math here. So in the Alti case, we'll assume that we have 1,000 shares of Alti. That's tying up roughly $5,400. And we're collecting, we'll say, a $90 premium with that amount. When we look at what we're risking and what we're getting premium-wise, it's coming out to about 1.6%, which is fine. Now in the example of our CRM spread bet, we don't need any shares of this. We're only risking a maximum of $500. However, we're collecting a $90 premium. So when we take that into account, we're really only risking $410. So when we look at 90 over 410, it's a 21.9% return. And the difference in capital that gets tied up is pretty substantial. Because on the right, we're only tying up $500. On the left, $5,400. So when we compare the two, our CRM spread bet is only using about 9% of the money. So we still have another $4,900 that we could go deploy somewhere else. And these spread bets aren't as rare as you think they are. Once you know how to look for them, you'll be able to spot on the chart, hey, I can probably deploy one here or one over there. The real issue is going to be seeing if there's enough open interest or liquidity to actually execute this trade. But finding them isn't the problem. Here's a quick clip I want to show you before I wrap this thing up.
Looking at this, down 10% for Figma. And I almost want to question that. Is Figma really down? Started the week at 58.98, and now at 52.91. Down 6.7% in the past few days, but it looks like Alti did not buy at the right price. They got unlucky. Because if they bought it exactly at the open on Monday, they only would have paid $56. But instead, looks like they bought closer to the end of the day when Figma was at $58, and it just kept averaging down. So bad timing there, unlucky. Yeah.
Roger's being extremely generous when he says they just got unlucky. The truth is, they don't care. They're firing off orders as fast as possible, following a checklist with zero regard for the actual stock. Is it uptrending? They don't care. Is it downtrending? They don't care. They're just dancing, popping off orders into the market, raking in their fat expense ratio while you're stuck on the ride. And this isn't investing. This is taking the whole instructions unclear meme to a whole new level. Because you're whipping out a shotgun, blasting into 20 different covered calls at whatever's moving, completely indifferent on whether the company is good, bad. All that matters is at the end of the day, the company sprinkles you with a couple of pennies while you're bleeding out money the other end. And people are losing their minds over this. If this strategy were really that good, you'd learn to do it for yourself. Spoiler, it's not. And while you're at it, learn to do these spread bets I've shown you. At least that way, when the market is actually in a downturn and not a couple dollars from the all-time highs, you're not pigeonholed into only going long. You'll have an actual tool in your arsenal that you can use to protect yourself. Those are my thoughts. Let me know yours in the comments. And remember, I get all my financial advice from my 3 cats.